Prologis Incorporated, ticker symbol PLD, is not your average real estate investment trust. It is the largest industrial REIT in the world with a market capitalization exceeding 100 billion US dollars. Prologis does not deal in malls, apartments, or office buildings. Instead, it owns and operates logistics real estate, specifically warehouses and distribution centers used by global supply chain giants. Its tenants include Amazon, FedEx, Home Depot, and even government agencies. In simple terms, Prologis is the backbone of e-commerce and global logistics. Without companies like Prologis, your online orders would never arrive on time. The company operates in over 19 countries and owns approximately 1.2 billion square feet of logistics space. That includes everything from last-mile delivery hubs to mega distribution centers near seaports, airports, and railways. This scale gives Prologis incredible pricing power and a strong competitive moat. No other industrial REIT comes close to its footprint. In fact, Prologis owns more than 4,000 buildings globally, with tenants occupying space in high-demand urban markets where land is scarce. Let's talk about its business model. Prologis makes money primarily through rental income. It leases warehouse space to thousands of customers under long-term agreements. The average lease term is around 7 years. And with annual rent escalations built in, Prologis enjoys predictable and growing cash flows. But it also benefits from something called embedded rent growth. And this means the current market rent for many of its properties is significantly higher than the rent its tenants are paying. When leases renew, Prologis can increase those rents to reflect market rates, boosting income without buying new properties. Now here's what makes Prologis really unique. It's not just a landlord. The company also develops new logistics facilities from scratch, especially in high-demand areas. It has an internal development pipeline valued at more than 30 billion US dollars. That's a major advantage because it can build exactly what tenants need and lease the properties out at strong returns. Plus, Prologis has a strategic capital segment. It runs investment funds with institutional partners, allowing it to earn fees and performance incentives on assets it co-owns. These layers of income make Prologis more than just a basic REIT. It is a full-stack logistics real estate platform. Now let's look at its financials. Prologis consistently delivers strong funds from operations, which is the key profitability metric for REITs. In 2024, the company posted over 6 billion US dollars in annual FFO. Its occupancy rate has remained above 96% for several years, showing how critical its locations are to tenants. The company has an investment-grade credit rating and maintains a conservative balance sheet. Its debt-to-equity ratio is around 0.6, and its weighted average interest rate is very low. This financial discipline gives Prologis resilience during economic downturns. Speaking of economic cycles, yes, industrial REITs are cyclical, but Prologis has a long track record of outperformance. During the COVID supply chain crisis, demand for warehouse space exploded. That gave Prologis huge pricing power, and it locked in many tenants at premium rates. Even now, as the economy cools, e-commerce growth continues to drive demand. The rise of AI and onshoring of manufacturing are also boosting warehouse needs. Prologis is positioned at the center of that structural shift. Let's talk dividends. Prologis pays a quarterly dividend and has increased its dividend for over 10 consecutive years. As of August 2025, the dividend yield sits near 2.5%. That may seem low compared to high-yield REITs, but remember, Prologis is a growth REIT. It combines stable income with capital appreciation. The dividend is well covered by cash flows, and management targets sustainable growth, not yield chasing. If you reinvest dividends and hold long-term, Prologis has historically beaten many REIT indexes in total return. What about risks? Prologis is not immune to interest rate hikes, construction costs, or tenant defaults. A major economic slowdown could reduce leasing demand. Additionally, rising supply in certain industrial markets could pressure rental rates. But Prologis has a proven track record of navigating those challenges. It has the balance sheet strength and tenant quality to weather downturns better than smaller peers. So who is Prologis best for? If you're a long-term investor seeking exposure to logistics, e-commerce, and global supply chains, PLD offers institutional-grade real estate with proven income growth. It is not a flashy yield play, it's a compounder. And because it owns critical infrastructure in some of the most expensive real estate markets in the world, its assets will likely remain in high demand for decades. Here is my meter rating for Prologis Incorporated. Income safety, 9 out of 10. Dividend growth potential, 8 out of 10. Capital appreciation, 9 out of 10. Risk level, moderate. Overall long-term rating, 9 out of 10. If you have any videos you'd like me to cover, say it in the comments below, and I will break it down in plain English.